focus on bad debts, provisions for bad debts recovered. And also we are going to look at what is a bad debt, the journal entries, and an example. So as we are going to start, we are going to look at what is a bad debt. So a bad debt is an amount due from trade receivables that is certainly known to be irrecoverable. So the journal entry for bad debts is debit the bad debts account and credit the trade receivables account. Means say that a bad debt is a customer which you consider that he is not going to pay. So there are certain reasons why some customers become bad debts. For example, maybe he's bankrupt, he doesn't have money, or the customer has died. If a person dies, you can't get the money, especially when a person takes a loan. If the person dies, you can't get the money because the person is no longer available. So at the end of each year, the total bad debts written off should be transferred to the profit and loss account. So you debit the profit and loss account, whereby in some circumstances there's a case where you treat bad debts as an expense. The general end is to debit the profit and loss account, whereby you treat the bad debts as an expense, then you credit the bad debts account. Then you have bad debts recovered. What is a bad debt recovered? A bad debt recovered is, let's take for example, if someone becomes bankrupt and he then gets the money, so he will be recorded in the books of account as a bad debt recovered, whereby maybe some bad debts recovered, they come after around 2 years or 1 year, even for months, where you have treated that person as a bad debt, then that person brings you back your money, it will become a bad debt recovered. So an amount received from a trade payable whose debt has been previously written off is called a bad debt. A simple and explained definition. So reinstate the trade payables account in the sales ledger. How do you record a trade payables account in the sales ledger? So you debit the trade payables account and credit the bad debts recovered account. So you create a bad debts recovered account. Then you also record the cash received from trade receivables. So you debit the cash or bank account, the amount that you have received from the bad debt. Sometimes it pays in cash or in terms of a check where you record it in the bank account. Then you credit the trade receivable account. Then we have the provisions for doubtful debts. What is the provision for doubtful debts? These are amounts which are set aside from profits to meet losses which a business might incur when trade receivables fail to pay. So that's the amount which we set aside in some circumstances whereby you may assume that this trade receivable may fail to settle their accounts by the end of the financial period, for example, 6 months, a year. So in some cases, you may set these provisions for bad debts account, these amounts. So in a scenario of Cambridge, they may ask you what is the provision for bad debts. But in Zimsec, they may ask you also to prepare a provision for bad debts, for provision for bad and doubtful debts account. So we have two types of provision for bad debts. We have the specific provision. This is a provision created by identifying certain trade payables in the sales ledger that the business is doubtful their ability to settle their accounts. There are some certain circumstances. For example, dairy board can have a view that this trade receivable, this customer may not be able to pay, so they may treat it as a specific provision that this customer they will be doubting that if this person has the ability or the audacity to repay the loan. Then we have the general provision. So the general provision, this is a provision created by estimating a certain percentage of the net trade receivables after deducting bad debts written off. So in this case, that's where we record the increase or decrease. We are estimating that a certain percentage might be paid off by the customer. So we have what we call a provision created for the first time. So a provision created for the first time, how do you record that one? So we debit profit and loss account and credit provision for doubtful debts account. So with the full amount of provision calculated. Then there is what you call an increase in provision. So an increase in provision, that's why we say we are given a provision for doubtful debts in the statement, in the trial balance. Whereas you're given a certain financial statements, you're given the provision for doubtful debts in the trial balance. For example, it is 500. Then they give you also what we call the percentage, for example 10%. Then they give you the trade receivables figure of 10,000. So how do you tackle that one? So to calculate the increase, you say, to determine if there was an increase or decrease, you say the 10% of the trade payables of 10,000, which will be 1,000. Then you compare the provision for bad debts which was given in the trial balance of 500 as compared to the 1000 which you got when you multiplied. The difference is the increase in provision, where you are going to debit profit and loss account. In this case, they mean that that figure you are going to record it as an expense in the profit and loss in the income statement. Then you are also going to credit that figure in the provision for bad debts account with an increase in provision. Same applies for the decrease in provision. The decrease applies when the figure is below the provision for bad debt. The figure which you have calculated is below the figure that has been given in the trial balance. Henceforth, we credit that figure in the profit and loss account, where in the income statement, you are going to record that figure under the gross profit section as other income. Add other income, you are going to record it as income. So decrease, we are saying there is an ability. So there is what you call provision for cash discount allowed. So provision for cash discount allowed, this is the amount set aside from profits to meet losses which a business might incur by the year end when giving cash discounts to customers or tradespeople. I've came across a certain question paper according to Zimsec where they asked the treatment of cash discount allowed. That's why I've added this note so that you may get assistance on how you can tackle that question. You can also research more on provision for cash discount allowed and how do you tackle it. So we are moving forward to example number 1. So example number 1, on 31 December 2000, Moyo's trade receivables totaled $6,000. He created a provision for bad debts of 5%. And on 31 December 2001, his trade receivables amounted to 9,000. He decided to write off the account of a customer owing $600, which he failed to trace. He also decided to maintain the provision for bad debts at 5% and to create a provision for discount allowed of 2%. Required, prepare the provision for bad debts account for the years ending 31 December 2000 and 2001. Prepare the provision for discount allowed for the, then prepare extract of the statement of comprehensive income. Then you are also required to to prepare extract of statement of comprehensive income and an extract of the statement of financial position for the end of 31 December 2001. So how do you tackle this question? So you're going to look at item A, the solution. So in this case, you asked to prepare the provision for bad debts account. So a provision for bad debts account has got a credit balance, but in this case, you are given the figure. So how do you calculate this one? Okay, so to calculate that figure, you have got a statement of comprehensive income. So you're going to say 6,000. The trade was total 6,000. He created a provision for bad debts of 5%. So note that the dates are essential when calculating these things. So you need to say 6,000 and 5%. We are going to get $300. Then there's a balance CD of 300 on the debit side. Then you balance off your account. Then no account ends with a balance CD. So you're going to cross to enter the balance CD as the balance BD, whereby it will be 2001, 1 January, balance BD $300. Then you are also asked to solve the next one. And on 31 December, his trade receivables amounted to 9,000. He decided to write off the account of a customer owing 600, which he failed to trace. He also decided to maintain the provision for bad debts at 5% and to create a provision for discount allowed at 2%. So we need to calculate how we are going to tackle this. So in this case, you see if there was an increase or a decrease. So how do you tackle this one? You are going to say 9,000 times 0.05. So 9,000 times 0.05, you get 450, but you don't record it as 450. You're going to say 450 minus the provision for bad debts of the previous period, which you're going to get 150. Then you add this amount, then your balance CD is going to be 450 on the debit side. Then you balance of your accounts, then you get your 4 marks. Then moving forward, we have the provision for discount allowed. So there are certain notes. In 2000, the provision for bad is created by multiplying 6,000 by 5%. In 2001, the provision for bad debts is supposed to be 450. 5% of 9,000. The account should therefore be increased by 150 since the other 300 were transferred in the previous year and the profit and loss is debited that increase. So now here comes the scenario. How do we calculate? Here comes the scenario. How do we calculate the provision for discount allowed figure? So we go back to our example. So we've been told that he also decided to maintain the provision for bad debts at 5% and to create a provision for discount allowed at 2%. So you calculate as this. So please note that the provision for discount allowed is a percentage of the net trade receivables, and in our example. So we have been told according to the definition at the notes which I have explained. So we are going to say 9,000 minus 450 in brackets. So you are going to multiply 2% times the net trade receivables, which is 9,000 minus the provision which you've calculated of 450. Then you get $171. Simple as that. Then moving forward, we need to look at the statements or the statement of comprehensive income extracts. So statement of comprehensive income extracts for 2000 and 2001. So you record 2000, 2001. As I have said, provision for bad debts, we record the 2001 there was 300, no other figure was there, so it would be 300. But in 2001 there was an increase. That's why we've recorded provision for bad debts as 150, because there was an increase from 300 to 450. We record 150. Then there are also bad debts of how much? Of 600, as stated in the question. If you go back to the question, they said he decided to write off the account of a customer owing 600, which he failed to trace. So we need to record that figure as, so you go back, then this he decided to write off the account of a customer owing $600, which he failed to trace. So you need to record that as the bad debts in your accounts. Then there was a provision for discount allowed of 171. There was an increase, so we record that figure. Then moving forward, we need to prepare the statement of financial position extract. So you record the trades payables, then you less the provision for bad debts. As I stated, you less the calculated amount of 450, then you less the provision for discount allowed of 171, then you get your figure 8379. So I also offer mathematics. I've got a YouTube channel, I've got a TikTok page, I've got a WhatsApp channel also. So if you want to know more about us, kindly WhatsApp me. And also for those who want online assistance based on mathematics and principles of accounting, we offer at affordable prices. Don't forget to like, subscribe,